Welcome to Talk Tickers.
It's good to be here.
You know, usually when we turn on the mics, we're diving straight into the weeds. We're looking at specific earnings calls, dissecting operating margins, arguing about forward guidance.
Try and figure out if a CEO is bluffing about Q4 demand.
Exactly. That's our bread and butter. We usually look at the trees.
We do. But today, we're doing something a little different. We're zooming way, way out.
We're looking at the whole forest,
Right.
Or maybe a better analogy is we're looking at the water that all the fish are swimming in. Because there's this massive structural shift happening in the market that affects every single ticker we talk about.
It's probably the single biggest shift in the history of modern finance. And the craziest thing is, it happened so gradually that most people, even seasoned investors, sort of missed the moment it fundamentally changed the game.
And we're talking about the migration for active management, stock picking, hedge funds, doing the actual homework to passive investing.
Index funds, ETFs.
The strategy we've all been told is the absolute smartest, safest way to build wealth. But here's the mission for this deep dive. We're going to explore why that safe bet might actually be rewriting the rules of risk.
It's what people are calling the passive paradox. The original idea was brilliant. Buy the market to avoid the risk of ticking the wrong stock.
Right.
But because everyone had the same brilliant idea at the same time, we've created this huge feedback loop. And that loop, well, it might be inflating bubbles, killing true diversification, and concentrating risk in a tiny handful of massive companies.
And before we get into the mechanics, we have to just look at the scale of this. The numbers are honestly staggering. Passive investing now accounts for over 50% of the entire U.S. stock market.
It's the dominant force now. It is the market.
And the flow of money is relentless. In 2024 alone, passive ETFs saw nearly $2 trillion in net inflows. $2 trillion.
And at the same time, active funds, the people trying to beat the market, they bled about $450 billion?
It's a tsunami. The money is it's all moving in one direction.
And leaving the stock pickers behind.
And the result is what we all see in the headlines, the Magnificent Seven. Those big tech giants, Apple, Microsoft, Nvidia, all of them, now make up roughly a third of the S&P 500.
32%.
So if you're listening and thinking, I'm fine, I own an index fund, I'm diversified, well, let's unpack that, because you might be making a massive leveraged bet on big tech without even realizing it.
Oh, you are. But to understand how we got here, we have to go back to the beginning. Because this didn't start as some plot to break the market. It started as a way to save the little guy.
Right. We have to go back to 1975.
1975.
Yeah.
A man named John Bogle founds Vanguard, and he launches the very first index mutual fund. You have to understand, at the time, Wall Street absolutely hated this idea.
They called it Bogle's folly, right?
They did. But the criticism was even harsher than that. Some critics actually called it un-American.
Un-American. For a mutual fund, that seems a bit much.
Well, think about the American ethos. It's about winning, about being exceptional. The idea that you would just settle for average.
Instead of trying to beat the market.
Yeah, that was seen as accepting mediocrity. It was like surrendering.
But Bogle wasn't surrendering. He was just doing the math. His logic was pretty much bulletproof. Don't look for the needle in the haystack.
Just buy the haystack. And the math backs him up. Active managers charge these high fees to find winning stocks, but the data consistently shows that after you pay those fees, the vast majority of them lose to the market average.
What's the number? It's something like 90%.
It is. About 90% of active managers underperform their benchmark over a 10-year period.
That's a damning stat. If 90% of the experts can't beat a simple index, why are we paying them?
That's the question that drove the entire revolution. And speaking of paying, the cost difference is just undeniable. This is the great compression in fees. Today, the average fee for a passive fund has dropped to something like 0.09%.
Basically free.
It's basically free. Now compare that to around 0.64% for active funds. That cost advantage is the engine. It's compound interest working for you, not for some guy in a suit.
So the revolution made total sense. It was rational. But fast forward to today, that folly is now the empire. We crossed that tipping point around 2024 or 25 where passive assets finally surpassed active.
And that's exactly where the physics of the market change. When you're 5% of the market, you're a passenger. You're just along for the ride.
But when you're 50 or 60%,
you're the driver. And the problem is, this particular driver is legally required to wear a blindfold.
Okay, let's drill down on that. This is the momentum machine idea. How does passive investing actually work mechanically that causes this problem? Why is the driver blindfolded?
It all comes down to how these indices are constructed. Most of them, like the S&P 500, are market capitalization weighted.
Meaning the bigger the company, the bigger its slice of the pie.
Correct. If a company's value goes up, it automatically gets a larger weighting. But here's the critical part that most people miss. Passive funds are what we call price inelastic.
Price inelastic. Okay, that sounds like jargon. Let's unpack that.
Sure.
Yeah.
It just means they're insensitive to price. Think about how a normal person shops. If you go to the grocery store and steak is $50 a pound, you might, buy chicken instead. You react to the price.
Right. I look for value. I'm not just going to buy something because it's expensive.
Passive funds don't look for value. When your automatic 401k contribution hits that fund, the fund must buy the stocks in the index. They have no choice.
They don't care if the PE ratio is through the roof or if the company is burning cash.
They don't care about valuation, earnings, sales growth, innovation, nothing. They only care about one thing. Is this company in the index? If the answer is yes and its price is high, the algorithm buys more.
So let's trace that feedback loop. Let's say I put $1 into an S&P 500 fund today.
Okay, that fund takes your dollar. It buys a huge chunk of Apple, Microsoft, Nvidia, because they're the biggest. That buying pressure, multiplied by trillions of dollars from everyone else, pushes those stock prices up even further.
And because the prices went up?
Their weight in the index grows. They become an even larger percentage of the pie. So the very next dollar that comes in
has to buy even more of those specific stocks.
It's a self-fulfilling prophecy. It's a momentum machine.
The winners keep winning just because they're winning.
Precisely. The largest companies get larger simply because they're large, not necessarily because their fundamentals justify it. It's called the index effect. The structural flow of passive money essentially guarantees that the top stocks get the most capital, regardless of whether they're actually the best investment at that price.
Which leads us directly to what you're calling the concentration trap, because I think the average person, maybe someone listening right now, looks at their portfolio, sees S&P 500 and thinks, great, 500 companies, I'm diversified.
That is the illusion of diversification. Yes, you own 500 names, but you don't own them equally. The reality is, the top 5 companies alone now make up about 30% of the index.
30%.
That is the highest level of concentration we've seen since at least the year 2000, right before the dot-com burst.
So, practically speaking, you're not really betting on the American economy. You're betting on big tech.
You absolutely are. The information technology sector makes up about 30% of the index. If tech takes a hit, say, from regulation or an AI winter or just interest rates staying high, your diversified index takes a massive, massive hit.
And when you look at the valuations, there's a huge gap opening up, isn't there?
A massive one. The Magnificent Seven have PE ratios that are consistently higher and growing compared to what people now call the S&P 493, the other 493 companies.
So passive money is just flowing disproportionately into the most expensive stocks.
We are essentially subsidizing the most expensive stocks in the market.
Yeah.
We're potentially creating a bubble in that top tier, fueled entirely by our own 401k.
It's funny, even Jack Bogle himself saw this coming. We found a note that shortly before he passed away in 2019, he warned about this. He said that if index funds owned half the stock market, it would not serve the national interest.
He was a wise man. He understood the danger of that concentration of power and the distortion of pricing. He created a tool for the little guy. But when everybody uses the same tool, the market itself starts to break.
And that brings us to the dark side of this shift. We're not just talking about high prices. We're talking about how the market actually behaves when things go wrong.
Volatility, liquidity.
Synchrony.
What's that?
It's just the idea that stocks are moving in lockstep more than ever before.
They all move together.
Right. When the index goes down, everything goes down together.
And that undermines the whole point of diversification, which is supposed to rely on assets not being perfectly correlated.
So if there's a panic, there's nowhere to hide.
And it gets worse because of the liquidity paradox. The funds themselves, the ETFs, are very liquid. You can sell them in a second. But they actually reduce the liquidity of the underlying stocks because passive holders don't trade. They just hold.
They're just sitting on the shares. They're not buying or selling based on news.
Exactly. So when a shock hits and people do try to sell, who is on the other side? In the old days, active value investors would step in and say, hey, this stock is cheap now, I'll buy the dip.
But the active managers are shrinking. We already established that.
Right. There are fewer of those shock absorbers. And because passive investors are inelastic, they don't react to price until they panic and sell everything, the market becomes much more fragile. We could see sharper, more violent swings because nobody is doing the homework to figure out what a company is actually worth.
We're increasingly flying blind.
That's a great way to put it.
That's a terrifying image, flying blind with all our retirement money. But let's pivot to solutions. We aren't just here to be negative. There are alternatives.
There are. And the most prominent one, the one getting a lot of attention lately, is the equal weight approach.
The S&P 500 equal weight index.
It's a very simple concept. Instead of giving Microsoft a 7% weight and a small industrial company a tiny fraction of a percent, you give everyone the same.
0.2% each. 500 companies, all equal slices of the pie.
That sounds a lot more like what people think they're buying when they buy an index fund.
It's definitely closer to the intuitive idea of diversification, but the magic of it isn't just that, it's the mechanism. It forces a discipline that most human beings hate.
Buy low, sell high.
Exactly. How does an index force you to do that?
It's all in the rebalancing. Let's say Nvidia has a great quarter and the stock rallies 50%. In a market cap fund, you just let it ride. It becomes a bigger part of your portfolio.
Right.
But in an equal weight fund, that Nvidia position is now bigger than 0.2%. So the fund manager must sell some of that winner to get it back down to its target weight.
They're selling into strength, taking profits.
Exactly. And the reverse is true. If a stock crashes but isn't going bankrupt, its weight drops below 0.2%. So the fund has to buy more of it to bring it back up. It's a built-in contrarian strategy.
So does it work? How is the performance?
The historical data is pretty compelling. Since 2003, equal weight has actually outperformed market cap in 12 of the last 21 years.
Okay.
And right now, the valuation difference is stark. The equal weight index is trading at a nearly 20% discount compared to the standard S&P 500.
That's significant. Better diversification, cheaper stocks, and historically good performance. So what's the catch? Why isn't everyone doing this?
Well, there are two main trade-offs. First, transaction costs are a bit higher because of all that rebalancing. But the bigger psychological hurdle is that you miss the rocket ship.
Right. If you're constantly trimming Nvidia as it goes up, you miss that ride to the moon.
Exactly. In a market totally driven by a massive tech boom, equal weight will lag. It has a value and a small cap tilt. So in a year like 2023, where big tech is the only game in town, you're going to feel like you're losing.
You'll be at the barbecue hearing your neighbor brag about their returns while you're sitting there with your diversified portfolio.
And feeling like a chump.
Which brings us back to the active managers. If passive investing is creating all these inefficiencies and mispricings, active managers should be having a field day, right? They should be killing it.
In theory, yes. This is the active manager's dilemma. If the market is inefficient, a smart human should be able to exploit it. But for the most part, they aren't yet.
Why not? If the food is hanging that low, why aren't they picking it?
It's the short squeeze problem. As long as that passive money keeps flooding in, it keeps pumping up those overvalued stocks. If an active manager says, that's a bubble, I'm going to bet against it, they can get wiped out before they're proven right.
There's that famous saying, the market can remain irrational longer than you can remain solvent.
That's exactly it. The flow of passive money is just so strong, it can override fundamentals for a very long time. And that pressure leads to another problem, closet indexing.
Closet indexing, I love that term.
It's what it sounds like. Active managers are so terrified of underperforming and losing their clients to cheap ETFs that many of them just secretly hug the index. They charge you active fees, but their portfolio looks 90% like the S&P 500.
So they charge you high fees just to buy Microsoft anyway, so they don't look bad.
Which means they aren't providing real price discovery either. They're just trying to survive.
So where does this all leave us? What's the future look like? We have this massive passive snowball rolling downhill. Active managers are scared. Concentration is at record highs. What happens next?
Well, the risk isn't that passive investing stops working in the sense that it tracks the market. The real risk is a reversion to the mean.
Reverting to the average.
Exactly. Markets move in cycles. If that tech bubble bursts or even just deflates for a few years, the standard S&P 500 is going to suffer significantly more than a truly diversified active portfolio or an equal-weighted one. The safe investment has become a levered bet on the status quo, and the status quo rarely lasts forever.
So let's bring this all home for the listener. We've gone from Bogle's folly to a $2 trillion momentum machine. What's the big takeaway?
I think the synthesis is that passive investing democratized wealth. It lowered costs for everyone, and that is a genuinely good thing. But its sheer dominance has changed the structure of the market itself. It's made the market top-heavy, prone to these synchronized movements, and dangerously dependent on just a handful of tech companies.
So the key takeaway is that buying the market isn't a neutral act anymore. It's now an active bet on big tech momentum.
It is. And that raises the final and maybe most provocative thought for everyone listening. If the whole world decides to just buy the average, who is left to decide what anything is actually worth?
Right, if we're all on autopilot.
What happens when that passive autopilot encounters a storm it wasn't programmed to navigate? If active price discovery disappears, markets cease to be markets. They just become a popularity contest based on past winners. And we all know popularity contests can turn ugly very, very fast when the mood changes.
That is definitely something to think about the next time you log into your brokerage account. Thanks for listening to Talk Tickers.